Hey everyone, welcome back to the channel. Pete here from Emanda, and today we're diving into the world of business valuation. Whether you're thinking about selling, buying, or just curious about your business worth, this video is for you. We're going to cover 4 key methods of valuation, break them down in a way that's easy for you to understand, and show you how our Emanda app can simplify the process. If you find this helpful, don't forget to give us a thumbs up and hit that subscribe now button. So, what exactly is business valuation? In simple terms, it's the process of determining what your business is worth in today's market. But let me tell you, it's not as black and white as it sounds. There are 4 main methods we're going to discuss today: book value, earnings multiplier, market value, and a discounted cash flow, everyone's favorite. Each has its own approach and can give you a different perspective on your business's value. Valuing a business is like comparing different TVs at a store. There's a wide variety of prices depending on the brand, the size, and the features of the TV. The same goes for businesses. The value is often determined by what someone is willing to pay, and it's crucial to have the right data to support that valuation. Let's explore those methods one by one. First up is the book value method. This is one of the simplest ways to value your business. It's calculated by subtracting your total liabilities from your total assets. This method is particularly useful if your business has valuable assets, but maybe not a lot of profit. So let's say your business has assets worth $100,000 and liabilities of $25,000. Using the book value method, your business would be valued at $75,000. However, if your liabilities are higher than your assets, your valuation could be negative, which essentially means your business wouldn't be considered worth anything at all, so it's worthless, until you either pay off the debt or increase your assets. Keep in mind though, the book value method doesn't account for future earnings potential, which is why it might not paint the full picture of your business's worth, and that's actually quite common. Next, let's talk about the earnings multiplier method. This method is based on the idea that your business's value lies in the ability to produce wealth in the future. It uses your earnings, usually measured as earnings before interest and taxes, or EBIT, to calculate your business's value. Here's how it works. First, you need to calculate your EBIT by subtracting the cost of goods sold and your operating expenses from your total revenue. Then you apply a multiplier, usually between 2 and 7, depending on the specific factors like industry trends and market conditions. For example, if your EBIT is $300,000 and your multiplier is 3, your business could be valued at $900,000. Choosing the right multiplier is key, and this is where Emanda can really help. Our app provides industry insights that can guide you in selecting a multiplier that accurately reflects your business's potential. Now, let's move on to the market value method. This approach looks at the selling prices of similar businesses to estimate your business's value. It's a bit like real estate, comparing your business to others in the same industry and adjusting for factors like location, size, and market trends. I guess that's why we see a lot of neighbors come to auctions and see what the house sells like to see what theirs would sell like 2 doors down. Imagine you own a retail store. If other stores in your area have sold for around $750,000, your business might be valued similarly, assuming all is equal though. However, this method has its limitations, especially if you can't find comparable sales data or if the market has shifted since the last time those sales actually occurred. That's where Emanda shines again. Our app helps you gather and analyze market data, making it easy to determine a fair market value for your business. Finally, we have the discounted cash flow method, or a good old DCF. This method estimates the value of your business based on its expected future cash flows, adjusted for the time value of money. Here's how it works. DCF analysis involves projecting your future cash flows and then applying a discount rate to figure out their present market value. The discount rate reflects the risk associated with your business and the potential returns an investor expects. For example, if your projected cash flow is $100,000, you'd apply a discount rate, calculated using something like your weighted average cost of capital, or WACC, the WACC, to determine how much that $100,000 is worth. DCF is a powerful method because it doesn't rely on competitor data and allows you to incorporate your assumptions about the future. But it's also complex and can actually be influenced by overly optimistic projections, which is why we commonly see people use this one when they want to project a higher price of their business. That's why using a tool like Emanda though, which simplifies these calculations, can be an absolute game changer to getting the mix of these valuations there and giving you the right value of your business, or at least what we think will be the most likely value of your business. And there you have it, 4 different methods to value your business. Remember, each method has its strengths and weaknesses, and the best approach may involve using a combination of them. At Emanda, we're here to make business valuation easier and more accessible for everyone, whether you're just starting out or you're looking to make a big move. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more insights on business growth and valuation. And obviously, if you have any questions, drop them in the comments below. Thanks for watching and see you in the next video.